Welcome to Securing Your Financial Future, a complete Canadian financial literacy guide designed to help you understand money, build wealth, protect your family, and plan your future. Whether you're just starting out or catching up, this video walks you through every key concept you need to take control of your financial life in Canada. Let's get into it. First, let's face the numbers. 35% of Canadians have no savings or investments. None. Zero. Only 27% of private sector workers have an employer pension to rely on. And the average RRSP balance in Canada sits around $55,000, far short of what most people need to retire comfortably. Here's the CPP reality check. The maximum CPP retirement pension is approximately $1,300 per month. That barely covers basic expenses. You cannot, and should not, rely on government programs alone to fund your retirement. The message is simple. Your financial future is your responsibility. Every financial decision you make flows through one equation: money. What you earn and save, plus time. The sooner you start, the better. Plus or minus rate of return. How hard your money works for you. Minus inflation, the silent wealth killer. Minus tax, minimized through smart accounts. The result? Wealth, your financial freedom. Master each part of this equation and you win. Ignore any part and it will cost you, often in ways you won't notice until it's too late. The single most powerful savings habit you can build is this: pay yourself first. Save 10 to 15% of every paycheck before you spend a dollar. Treat it like a non-negotiable bill. Automate contributions to your RRSP, TFSA, or RESP, and increase your savings rate by just 1% every time you get a raise. Here's what small changes actually look like over 30 years at 8% growth. Skip one latte a day. $100 per month becomes $150,000. Cut dining out $200 per month becomes $298,000. Skip subscriptions $300 per month becomes $447,107. All three combined $600 per month becomes $894,214. As Warren Buffett said, don't save what is left after spending, spend what is left after saving. That's the mindset shift everything else is built on. Here's one of the most powerful concepts in personal finance, the rule of 72. Divide 72 by your annual rate of return, and you get the number of years it takes your money to double. At 4%, your money doubles every 18 years. At 8%, your money doubles every 9 years. At 12%, your money doubles every 6 years. Let's say you invest $10,000 at age 29. At 4%, by age 65, you have $40,000. At 8%, by age 65, you have $160,000. At 12%, by age 65, you have $640,000. Same starting amount, same time. The only difference is the rate of return. The gap between a 4% and a 12% return over 36 years is $600,000. That's 20 years of salary at $30,000 a year. The rate of return matters enormously. There's a famous example that illustrates the power of starting early. Mr. Start Early invests for just 7 years in his 20s, then stops. Total invested, $25,200. Mr. Wait Longer starts 7 years later and invests for 17 years straight. Total invested, $61,200. At retirement, their final balances are nearly equal, even though early invested less than half the money. The lesson? Start now. Even $100 per month at age 22 outperforms $300 per month started at age 35. Time in the market beats the size of the contribution. Inflation is the enemy most people forget to fight. At just 3% annual inflation, here's what happens to $100 of purchasing power. In 5 years, you need $116 to buy what $100 buys today. In 10 years, you need $134. In 20 years, you need $181. In 30 years, you need $243. Planning to retire on $4,000 per month in today's dollars? In 10 years, that requires $5,376 per month to maintain the same lifestyle. In 20 years, $7,224 per month. In 30 years, $9,707 per month. Your investments must earn more than inflation, or you're losing wealth in real terms. A savings account paying 2% in a 3% inflation environment is not saving you money. It's costing you money. In Canada, where you put your money determines how much tax you pay and when. There are 3 categories. Tax Now accounts. You pay tax on earnings every year. This includes regular savings accounts, non-registered GICs, and non-registered investments. Tax later accounts. You defer tax until withdrawal. This includes your RRSP, RRIF, LIRA, RESP, and your future CPP and OAS income. Tax-advantaged accounts. You pay tax on contributions, then never pay tax on growth again. This is the TFSA, the most powerful tool in Canada, along with the FHSA and life insurance cash value. Understanding this framework changes everything about how you structure your savings. The RRSP is Canada's primary retirement vehicle. Here's how it works. You can contribute 18% of your prior year earned income, up to $32,490 in 2026. Contributions reduce your taxable income dollar for dollar. All growth is tax-deferred until withdrawal. You can use a spousal RRSP to split income with your partner in retirement. You must convert to ARRIF by age 71. Here's the magic. Contributing $10,000 in a 40% tax bracket means the government gives you back $4,000 as a tax refund. Your real cost? $6,000. The government is literally funding $4,000 of your retirement. Best for high-income earners, where the deduction is most valuable. The TFSA is Canada's most powerful tax-free growth vehicle. Every dollar of growth inside a TFSA is yours, forever. Interest, dividends, capital gains. ALL tax-free. No tax ever on withdrawals. For 2026, the annual limit is $7,000. If you've never contributed since 2009, your cumulative room is approximately $102,000. You can withdraw anytime with no penalty. The withdrawn room comes back the following January 1st. You can hold anything inside a TFSA: stocks, ETFs, bonds, GICs, mutual funds. RRSP or TFSA. Most Canadians benefit from both. Use RRSP in high-income years for the deduction. Use TFSA for tax-free income in retirement. If you have children, the RESP is money you simply cannot afford to leave on the table. The government gives you a 20% grant, called the CESG, on the first $2,500 you contribute per year. That's $500 per child per year for free. The lifetime maximum government grant is $7,200 per child. Contributing $200 per month from birth? That's approximately $79,300 by the time your child reaches university, enough for most Canadian programs. Don't leave free government money behind. Open an RESP as early as possible. Let's map out all the accounts available to you. TFSA, tax-free forever, $7,000 per year in 2026. RRSP tax deduction now, deferred until 71, up to $32,490 in 2026. FHSA, first home buyers, deductible and tax-free, $8,000 per year, $40,000 lifetime. RESP, education savings, 20% government grant, $50,000 lifetime limit. RDSP, disability savings, up to $90,000 in government support. Non-registered unlimited contributions, capital gains taxed at 50%. Dividend tax credits available. Fully flexible. Use the right account for the right goal. This single decision can mean hundreds of thousands of dollars difference over a lifetime. Debt is wealth in reverse. Every dollar of interest paid is a dollar stolen from your future self. Here's the credit card trap in real numbers. A $5,000 balance at 20% interest paying $200 per month. Minimum takes 133 months. That's 11 years to pay off. And you'll pay over $3,000 in interest. The debt elimination strategy in 5 steps. Step 1. Stop adding debt. Cut cards. Use cash. Live below your means. Step 2. List all debts. Smallest balance first or highest interest first. Step 3. Pay minimums on all debts. Step 4. Add every extra dollar to your top target debt only. Step 5. When one is paid off, roll that payment to the next debt. This is the debt snowball. One more. Adding just $500 per month to a $300,000 mortgage saves 12 years of payments and tens of thousands in interest. One of the most important concepts in lifetime financial planning is the X-curve. When you're young, you have high financial responsibility, young children, mortgage, little savings, and high insurance needs. As you age and build wealth, your savings replace the protection role of insurance. Think of it this way. At 25, $500,000 of insurance, $10,000 in savings. At 35, $400,000 of insurance, $100,000 in savings. At 45, $200,000 of insurance, $300,000 in savings. At 65, $0 insurance needed, $500,000 plus in savings. The goal is to become self-insured. Your savings eventually become large enough that you no longer need insurance. Your wealth is your protection. Life insurance doesn't insure your life. It insures your family's financial future. Use the DIME method to calculate how much you need. D. Debt. All credit cards, loans, car. Example, $50,000. I. Income replacement, $3,000 per month for 10 years. Example, $360,000. M. Mortgage, outstanding balance. Example, $200,000. E. Education, $15,000 per year per child for 4 years. Example, $120,000. Total need in this example, $730,000. There are 3 main types of life insurance in Canada. Term insurance, pure protection for a fixed period. Low cost, no cash value, best for young families. Whole life, permanent coverage with a cash value component. Guaranteed rate, conservative. Universal life, flexible premiums with an investment component. Market-sensitive growth. A good rule of thumb, 10 times your income in insurance if you die too soon. 20 times your income in savings if you live too long. When you take CPP, makes a massive difference. Taking CPP at 60, you receive 36% less, about $835 per month. Taking CPP at 65, the standard baseline, about $1,306 per month. Taking CPP at 70, you receive 42% more, about $1,855 per month. The break-even on deferring from 65 to 70 is around age 83. With average Canadian life expectancy now exceeding 85, deferring CPP is often the optimal strategy. For OAS, eligible at 65, you receive about $728 per month in 2026. Defer to 70, and that rises to about $1,031 per month. OAS clawback begins at $90,997 in net income. The optimal strategy for many Canadians: draw down RRSP in your early 60s to fill lower tax brackets, then delay both CPP and OAS to age 70 for the maximum guaranteed lifetime income. 4 core investment principles that matter most. 1. Time beats timing. A 20-year hold has never lost money in the history of the S&P 500. Don't try to time the market. 2. Dollar cost average. Invest the same dollar amount every month. You automatically buy more shares when prices are low. 3. Asset allocation. Mix stocks and bonds based on your stage of life. A common starting rule: 100 minus your age in stocks. 4. Don't be emotional. Buy and hold investing has historically returned 8.2% annually. The average investor who trades emotionally earns 4.3%. The gap is behavior, not skill. ETFs versus mutual funds. The average ETF charges 0.1 to 0.25% in fees. The average mutual fund charges 1.5 to 2.5%. On a $500,000 portfolio over 30 years, that fee difference costs you hundreds of thousands of dollars. Let's look at what it takes to reach $1.5 million, enough for $5,000 per month for 30 plus years, depending on when you start. Start at 25. $650 per month at 7% for 40 years, right pointing arrow, $1.7 million. Achievable. Start at 35. $1,350 per month at 7% for 30 years, right pointing arrow, $1.6 million. Achievable. Start at 45. $3,200 per month at 7% for 20 years, right pointing arrow, $1.6 million. Challenging. Start at 55. $8,800 per month at 7% for 10 years, right pointing arrow, $1.5 million. Very hard. Every 10-year delay roughly doubles the required monthly contribution. The cost of waiting is enormous. Start today, even if you can only start small. Once you're retired, you need to turn your savings into sustainable monthly income. This is called decumulation, and it has 4 pillars. Pillar 1, guaranteed income first. CPP, OAS, and any pension covers your baseline expenses. These are guaranteed for life. Pillar 2, RRIF minimum withdrawals. Mandatory from age 72. Withdraw strategically to avoid bracket creep and the OAS clawback. Pillar 3. TFSA as tax-free top-up. Use your TFSA for large expenses or to bridge income without triggering OAS clawback. Pillar 4. The 4% rule as a guide. Withdraw 4% of your portfolio annually. On $1 million, that's $40,000 per year. The optimal RRIF strategy. Begin drawing down your RRSP starting around age 60 before CPP and OAS kick in. Let's meet Alex, age 25, earning $65,000 per year, paying $1,400 per month in rent with $22,000 in student debt and almost no savings. Here's the priority action plan. Step 1. Build a $5,400 emergency fund, 3 months of expenses in a TFSA high-interest savings account first. Step 2. Get $500,000 in 20-year term life insurance. Cost: about $25 per month. Get it while you're young and healthy. Step 3. Attack student debt with an extra $300 per month, paid off in 4.5 years instead of 10, saving $4,500 in interest. Step 4. Invest $300 per month in an all-in-one ETF like XEQT in a TFSA. At age 25, go 100% equity. Time is on your side. Step 5. Once debt is clear, start contributing $500 per month to RRSP. The tax refund effectively reduces your real cost to $300 per month. Projected outcome at age 65. RRSP, RRIF of approximately $800,000, TFSA of $450,000, CPP and OAS together of about $2,000 per month. Total after-tax income, approximately $5,200 per month. That's a comfortable retirement built on consistent habits starting today. Now let's look at a married couple. Combined income $140,000. 2 children aged 3 and 5. A $450,000 mortgage. Some RRSP and TFSA savings. But no RESP. Started and only $250,000 of life insurance through work, which is nowhere near enough. The immediate priority checklist. Increase life insurance to the dime need, approximately $1.2 million each. Add disability insurance immediately. Your income is your greatest asset. Open RESPs for both children. Put in $2,500 per child per year to max the CESG government grant. Continue RRSP contributions of $1,000 per month each. Max TFSA every year. Add $500 per month to the mortgage, saves 8 years and $95,000 in interest. Create wills and powers of attorney. Essential with young children. The critical gap here: 2 young children, a $450,000 mortgage, and no disability insurance is a catastrophic financial risk. Insurance always comes before investing. Here's someone with $380,000 in RRSP, $85,000 in TFSA, $120,000 non-registered, and $450,000 in home equity. 10 years from a planned retirement. The 10-year countdown plan. Eliminate all non-mortgage debt immediately. Maximize RRSP for the next 5 years. This reduces taxable income significantly. Max TFSA every year for tax-free income later. Review life insurance. You may no longer need $1 million of coverage. Begin the RRSP meltdown at age 60 before OAS and CPP begin. Target CPP and OAS at age 70 for maximum lifetime income. Projected retirement income at 65, approximately $5,886 per month, or $70,632 per year. After tax, about $5,200 per month. A comfortable Ontario retirement built through a disciplined decade of planning. Your estate plan ensures your wishes control what happens to your assets, not the government's default rules. 4 essentials. A will directs how your assets are distributed. Without one, provincial intestacy rules apply, often not what you choose. Name a guardian for your minor children. Powers of attorney. A property POA manages your finances if you're incapacitated. A personal care POA manages your health decisions. Both are essential before age 60. Beneficiary designations. Your RRSP, RRIF, TFSA, and life insurance all pass directly to named beneficiaries outside the will with no probate. Review these every 3 to 5 years. Trust planning. Testamentary trusts reduce taxes for heirs, protect assets for minor children, and are used in family wealth and business succession. One important note: Life insurance death benefits pass to beneficiaries completely tax-free. This makes life insurance one of the most tax-efficient estate tools available to Canadians. Let's bring this together by life stage. 0 to 17. Childhood. RESP. Life insurance on parents. Begin financial literacy. 18 to 24. Student. Open a TFSA. Build emergency fund. Avoid debt traps. 25 to 35. First job. Term insurance. FHSA. RRSP. TFSA. Kill student debt. 35 to 45. Family. Maximum protection. RESP. Mortgage paydown. Disability insurance. 45 to 55. Midlife. Max RRSP and TFSA. Reduce debt. Review coverage. Plan RRSP meltdown. 55 to 65. Pre-retirement. Melt RRSP. Delay CPP and OAS. Build TFSA. Finalize estate plan. 65 and beyond. Retirement. RRIF withdrawals. TFSA. Tax-free income. CPP and OAS. Legacy planning. Know your stage. Here's the protection most Canadians completely ignore. 1 in 3 Canadians will be disabled for 90 days or more before age 65. The average disability claim lasts 157 days. And the average monthly benefit needed to cover basic living expenses is $3,500. Disability insurance replaces your income when you cannot work. Without it, one injury or illness can destroy everything you've built. Critical illness insurance pays a tax-free lump sum, typically $50,000 to $500,000, on diagnosis of a covered illness, regardless of whether you can still work. With 90% of Canadians having at least one heart disease risk factor, and 1 in 2 Canadian men developing cancer in their lifetime, this coverage matters. A 35-year-old earning $80,000 per year has $2.4 million in future lifetime earnings ahead. That income is your greatest asset. Protect it. If you're self-employed or incorporated, you have access to strategies beyond registered accounts. Individual Pension Plan, IPP. Contribute $25,000 to $40,000 per year, more than RRSP limits, with contributions deductible by your corporation. Corporate-owned life insurance. Your corporation pays premiums with pre-tax dollars. The death benefit flows to shareholders via the capital dividend account. Completely tax-free. Holding company strategy. Retain business profits in a holdco and invest tax-efficiently. Access capital gains exemptions on sale of operating company shares. Health spending account. Convert non-deductible personal medical expenses into a legitimate business deduction. If you own a business, proper planning can save you few thousands of dollars. If you're a new Canadian, here's your foundation building checklist for the first 2 years. 1. Get your social insurance number required for all Canadian accounts. 2. Open a TFSA immediately. Contribution room builds from the day you become a resident. Don't lose years of room. 3. File your tax return every year. It builds RRSP room and unlocks benefits like GST/HST credits and the Canada Child Benefit. 4. Build Canadian credit history. Secured card first, then regular credit. 5. Get life and disability insurance while you're new and healthy. 6. Open an RESP if you have children. CESG grants start from your first contribution. Common misconceptions to clear up. CPP pays internationally, even if you return home someday. Your RRSP and TFSA give you independence, so your children don't become your retirement plan. And tax-advantaged room that goes unused is gone forever. Start small. Start now. True wealth isn't spent, it's multiplied and passed forward. Generation 1, that's you, maximizes registered accounts, builds an emergency fund, eliminates consumer debt, establishes a will, and models financial discipline for children. Generation 2, your children, inherit within a tax-efficient structure, open their own TFSA at 18, and build on the foundation you created. Generation 3, your grandchildren, are born into established family wealth, with RESPs funded from birth and trust distributions for education. $100,000 invested today at 7% becomes $1.5 million in 40 years. Teach your children the same principles, and that compounds through generations. That is generational wealth. Build your financial life from the bottom up. Each layer enables the next. Layer 1, protection first. Life, disability, critical illness, emergency fund. Without this, everything else is vulnerable. Layer 2, debt management. Eliminate consumer debt, highest interest first. Layer 3, emergency fund. 3 to 6 months of expenses in a TFSA high-interest savings account. Layer 4. Registered accounts. TFSA, RRSP, FHSA, RESP. Maximize in priority order. Layer 5. Investments. ETFs, stocks, bonds, real estate, inside and outside registered accounts. Layer 6. Legacy. Estate plan, trusts, generational wealth transfer. Every layer protects and enables the one above it. Before any investment decision, pass these 4 tests. 1. Can it grow to meet my goal? Does the expected return, after inflation, compound toward your target? A savings account at 1.5% cannot fund a 30-year retirement. Diversified equity ETFs historically can. 2. Is it safe enough for my stage? Young investors can handle volatility. Time heals market dips. Pre-retirees need stability. Match risk to your timeline, not your comfort level. 3. Does it have tax advantages? The same investment inside a TFSA versus outside costs you 30 to 50% more in lifetime tax. Tax efficiency multiplies returns. 4. Is it properly protected? Insurance, emergency funds, and estate planning ensure your portfolio isn't wiped out by one catastrophic event. An illness, a death, a lawsuit, or a market crash. Here's a comparison that changes how most people think about their money. Example 1. AGIC at 3% interest. After 40% tax, you keep $1.80 on a $100 investment. After 3% inflation, your real return is negative $1.20. You lost purchasing power. Example 2. A diversified ETF inside a TFSA returning 8%. Tax, 0. After 3% inflation, your real return is positive $5 on every $100. You genuinely grew your wealth. The most powerful wealth-building combination available to Canadians is the TFSA plus diversified equity ETFs. Tax equals 0. Historical return approximately 8%. Real return approximately 5%. Year after year after year. Understand this, and you will never look at a GIC the same way again. Here's the hardest truth in investing. The biggest enemy of your financial future is the person in the mirror. Common investor biases that cost people money. Loss aversion. The pain of a loss feels twice as strong as the pleasure of an equal gain. This causes people to hold losing investments too long. Recency bias. Assuming recent trends will continue. Buying high after a rally. Selling low after a crash. Herding. Following the crowd into bubbles and out during panics. Overconfidence. Believing you can pick stocks better than the market. The antidote? Automate everything. Set up pre-authorized contributions. Choose a diversified ETF. Let compound interest work. Don't check daily. Don't react to headlines. Time in the market, not timing the market. That is the most important lesson. Knowledge without action means nothing. Here's what to do in the next 90 days. Week 1 and 2. Calculate your dime insurance need. Pull your credit report for free at equifax.ca. List all debts with balances and interest rates. Check how much TFSA room you have unused on CRA My Account. Week 3 and 4. Set up an automatic transfer to your TFSA savings account. Open an RESP if you have children. Even just $100 to start. Get a 20-year term life insurance quote for 10 times your income. Meet with a fee-only financial planner. Month 2. Open a discount brokerage, Questrade or Wealthsimple. Choose an all-in-one ETF, XEQT, VEQT, or XBAL. Set up a pre-authorized contribution, same amount invested every month. Review your mortgage. Can you add $200 to your payments? Month 3. Review or create your will and powers of attorney. Update beneficiary designations on all accounts. Calculate your retirement number, 20 times your target annual income. Schedule an annual financial review. Set a recurring December calendar reminder today. Here are the key numbers every Canadian should know for 2026. TFSA, $7,000 per year. Cumulative room, approximately $102,000 if you've never contributed. RRSP, up to $32,490 maximum, or 18% of your prior year earned income. FHSA, $8,000 per year, $40,000 lifetime. RESP, no annual limit, $50,000 lifetime. CPP maximum at 65, approximately $1,306 per month. OAS at 65, approximately $728 per month. OAS clawback threshold, $90,997 in net income. Basic personal amount, $16,129 federal. Capital gains inclusion rate, 50%, confirmed for 2026. CESG grant, 20% on the first $2,500 contributed to an RESP per year. That's $500 per child per year, free from the government, up to a lifetime maximum of $7,200. Know these numbers. They are the tools of your financial toolkit. There is nobody more interested in your financial future than you are. That's the most important sentence in this entire video. Not your bank, not the government, not your financial advisor. You. Here are the 5 principles to take away. 1. Start now. The cost of waiting is compounding against you every single day. 2. Protect first. Insurance before investment. Always. One uninsured catastrophe can undo decades of saving. 3. Use every tax advantage Canada offers: TFSA, RRSP, RESP, FHSA. Every year of unused room is money left on the table. 4. Automate your savings. Remove the emotional decision from the equation. 5. Review annually. Your financial plan must evolve as your life does. Financial independence is not a dream. It is a decision. Take control of your future. Start today.